You guys in the real estate world know who Robert Kiyosaki is. He's famous for a book called Rich Dad, Poor Dad, but he also wrote another book called Second Chance. The method that I teach, Robert Kiyosaki talks about in that book. The concept has been around for over 200 years. So it's not on trial. It's not being tested, right? All we're going to do, Tim, is we're going to use the tools that the wealthy have been using for over 200 years, and we're going to follow what they've been doing. The machine that we're going to use to build wealth, I'm about to tell you what that is, and it's going to surprise you, and it's going to surprise a lot of your listeners after I tell you what it is.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Brent Kesler. Brent Kesler was a chiropractor and chiropractic coach for over 14 years. After implementing the Money Multiplier Method, he paid off nearly $1 million in debt in 39 months. In fact, Brent became so passionate about how powerful this concept was, he began sharing it with others. Now, his main goal is to help more people understand how to manage and grow their wealth. Brent, welcome to the show.
Hey, Tim, thanks for having me. I'm excited to be here to share.
Yeah, I'm excited to have you. So I gave everyone a very high-level overview of your background, but on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Yeah, absolutely. As you said, I am a chiropractor. I no longer practice chiropractic anymore. I actually have not practiced since 2008. I owned 5 clinics in the Kansas City area. I sold my last clinic in 2017. My wife and I became empty nesters, and we moved back to my home state of Florida. So now I live in Port Orange, Florida, which bumps up right next to Daytona Beach, about an hour east of Orlando. So as a chiropractor, again, I was helping patients. That's what I was doing. I was there to serve patients and help just with their health. And now basically the thing I do is I still help people with their health, but it's their financial health. Anyway, I went from chiropractic and I got involved in this thing called the infinite banking concept. And anyway, there's a book out there. It's called Becoming Your Own Banker. And a guy named Nelson Nash wrote this book. And actually, Nelson Nash, he passed away about 4 years ago in 2019 at age 87. But actually, Tim, this book completely changed my financial life. So I tell people, go get that book. Add that book to your financial library. I'm not here to sell you the book, but a lot of what I teach is, okay, so the information comes directly from that book. So it was back in 2006 that I was at a conference. Chiropractic conference, and I heard somebody at that conference talk about this thing called the infinite banking concept. And I'm like, man, that is really cool, but it just sounds too good to be true. And I'm sure you, Tim, as well as a lot of your listeners, have seen things like that where it looks good, but it seems too good to be true. So there's got to be a catch. So I heard all the information. I took it all in at that conference back in 2006. And I left that conference. I left the conference with this book in hand. And I got back home to my normal chiropractic life. I put the book on the shelf and totally forgot I even had it, right? So I did nothing with the information that I heard. And that's what a lot of people do. Again, so there's a lot of people that'll hop on these podcasts or Zoom calls or even attend these live events, like a lot of real estate events. People will go there. They get a lot of information, but they don't act on anything, right? They just don't implement. So I call them professional seminar hoppers. They hop from one seminar to the next and get all this info, but never act on it. That was me in this concept. So in 2006, I didn't do anything with it, took the book home, went back to my normal life. About almost 2 years later, I go back to another chiropractic conference at the end of 2007, early 2008. And about 10 or 12 of my colleagues, Tim, are now at this conference that were at the conference with me before. Now, the only difference between them and me is they took the information that they heard and they implemented it at the time they heard it in '06. So now I'm at this conference and I have my colleagues, about 10 or 12 of them are coming up to me. They're basically throwing up all over me saying, Brent, this banking concept is so powerful. I'm able to pay off debt. I'm recycling, recapturing my dollars. I'm keeping control of my money. They're being leaked out, okay, just to other people. This concept is changing my financial life. So I thought to myself, there has to be something to this, right? There's no way 10 or 12 of my colleagues are lying to me, maybe one or two, but not 10 or 12. So I go home and I tell my wife, I said, honey, we have to start implementing this concept in our life. And it was in February of 2008. And again, I came home and I told my wife, we got to start implementing this. And it was at that time, I was $984,711 in debt. That's what I owed to the third party creditors. Now you're probably thinking, Brent, how do you get to be almost $1 million in debt? I had my student loans from chiropractic college. I had the house that I lived in. I also had a house on the Lake of the Ozarks between St. Louis and Kansas City. And obviously, Tim, if you have just a house on the lake, guess what you have to have? A boat and a wave runner, right? Yeah, man. So you can't have a house on the lake without a boat and wave runner. And I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. I was able to apply this concept and I was able to pay off that debt in 39 months, 3 years and 3 months. And all I did, Tim, is I added one step into my financial life. I did not have to change my cash flow. I didn't have to work any harder, take any additional risk, or lose control of my money. I added one simple step in my financial life, and that drastically improved my financial life. So I became so passionate about it that I was just telling others about the stuff that I was doing, because I was also coaching at the time. I was coaching other chiropractors on the sales and marketing of the chiropractic business. I wasn't just necessarily teaching clinical aspects, the sales and marketing. If I'm talking to somebody about the sales and marketing of their chiropractic business, I have to talk to them about how to keep their money, how to grow their money, and things like that. So I just started telling other people about this banking concept and just what I was doing. And I went to the guy that I started my first banking process with, and he came downstairs. And again, his name was Ray. And so Ray told me, he says, Brent, he says, I was looking through my records because I went to his office to talk about as far as my banking policies. And he came downstairs and says, Brent, I was looking through my records and I've seen here that you referred me 42 clients. And I said, Ray, you've never paid me a dime for any of those clients I referred you. And I kind of laughed about it. And he says, no, he says, listen, in all seriousness, he says, you're very good at this. He says, you're telling people about it. He says, you should consider doing this. I said, really? How can I do it? And he says, go out and get your license. I'll train you. I'll teach you. I'll mentor you. So that's what I did in 2012. So I've been teaching this concept now, the infinite banking concept, since March of 2012. So I'm a little more than 11 years old. And I decided that, look, this is what God put me on this earth to do, is to serve as many of his children as possible through these teachings on this method. So now that's what I do. I sold all my chiropractic clinics, completely changed careers, and now I'm 100%. I eat, live, and breathe this banking concept. And as we were talking before that we jumped on the show here, is that prior to the pandemic, I was speaking, I don't know, like 40 to 60 to 70 live events a year prior to the pandemic. Pandemic came, everything just went to virtual. And here we are, we're sitting here in May of 2023. And over the last 18 months, all the live events are coming back, and I'm traveling around now and teaching on stage and also doing podcasts and Zoom calls just like this. But I just teach people to do in their financial life the same thing that I do. And I know this is a real estate show, and I teach it. Probably 2/3 of my conferences that I teach at have to do with real estate investors. I myself, I have quite a few properties, short-term rentals, long-term rentals, and I do a lot of lending. I do lending where I'm in basically first position of the loan. The real estate is the collateral. Sometimes it's personal deals, sometimes they're trailer parks. And as we were talking before the show, I've been doing here recently over the last 18 months, probably these big real estate development deals where I go in and the people are looking for the money because it's usually quick money as far as a turnaround within 2 years. So I'll lend the money. I'm not investing in the deal. It's a loan. It's a loan. I don't have anything to do with the investment. I just make sure I'm in first position and I get paid interest only normally on my money. And about every 2 years or even sooner, because I've already had a couple deals that I've been in developments, they've totally closed out. They paid me back. And then I'll just take that money and invest it into a new development or to another deal. So that's been working very well too. So a lot of my money I have invested in the real estate world, but I run it through this concept we call the infinite banking process first. So I'm adding that one step in my financial life before I go make the real estate deal.
Yeah, and obviously you talked about so much there, but I think some of the high points that I want to hit on is one of the first things you talked about was financial health and how that is so important and equally important to physical health. And I think we don't focus on that enough, especially here in America for whatever reason. Compared to other countries I've been to, it's a taboo topic to
Yeah.
talk about money. And I really think, and I try to tell people all the time, people will not get out of the situation they're in unless they talk about. But you will
Yeah.
never get better at it if we don't talk about it. So I think as a society and in schools and everything else, we obviously need to do a better job about teaching basic financial habits. Then we can get into the more advanced stuff like what you and I are talking about. But let's set that baseline first and then talk about money around the dinner table. I have no problems doing that with my daughters. We buy them a book on what is monetization with a little dinosaur that tells them what monetization is, just so that they can get introduced to the concepts. And there's not this weird stigma around it.
Yeah, Tim, that is so true. And I talk about that a lot. So, as I stated earlier, right? So, like, I'm a chiropractor, right? Now I'm just helping people with their financial health because, again, so let's just talk about this for a minute. The number one cause of death in the United States is heart disease. That's the number one cause of death. The number one cause of heart disease is what? Is stress. What's the number one cause of stress? Is money, right? So the thing that we can do, if as long as we can solve a person's financial problems, we can decrease the stress levels in their life, which will decrease probably the heart disease in their life. And I'm totally 100% on board with you. People do not talk about money. Just think about your family dynamics. How often are you getting around the kitchen table or the dinner table talking about money? See, I don't care how good you're doing or how bad you're doing. It's a sour subject. We get together as families over Easter, Thanksgiving, and Christmas, and all the crap we talk about is everybody's problems. What's going on with Mary's ailments and aches and pains, or Grandma Jenny, or this and that. We're not talking about money. I purposely trick my children. They're a little older now. My youngest is 21. My daughter that actually works with me is 23. And as I said, I've been doing this. I've been implementing this process in my life since 2008. So that's the last 15 years. I've been teaching it for the last 11 years. So they were kids when I started doing this. And of course, kids, sometimes you got to just drag things out of them to get their attention. So what I would do is I would say, kids, hop in the car. We're going to go get ice cream. And as we're driving down the road to get ice cream, I'm talking to them about money. Now, the kids will not get out of a moving car. They just won't jump out. They may want to jump out, but they don't. So you have them trapped in that moving car. So we have to do a better job of talking about with the family about wealth and keeping that money in the family. Probably some of my most favorite clients that I have, and I have over 7,000 of my own personal clients in every state of the country, but probably some of my most favorite is when I go out to Utah. Now, why Utah? Because who lives in Utah? The majority of the population are Mormons. Mormons are a big family. It's all about family. So these Mormon families will invite me in their house and they bring all their family members with them that most of them have. If a Mormon has a half a dozen kids, that's a small family, right? But they're bringing their kids, their spouses, their grandkids, nieces, nephews, these big families, and they actually get together and they talk about money, right? So that's what we need to do better. That's what we need to do more of. And we need to teach our children these concepts and the method of how to keep wealth, to build wealth, and to create wealth. And that's what I do. That's what I teach in the Money Multiplier Method or the infinite banking concept.
Yeah, I couldn't agree more. And another thing that you talked about that I think is applicable in almost any type of investing is that tire kicker mentality. People start to read the books, listen to the podcasts, go to the conferences, and they're getting in all this information they're consuming, but then they're not actually doing anything. And I think that's what people need to understand about investing is that the sooner you start, the more it's going to compound and the better it's going to be. But if you just learn about it, there's no inherent value in just learning. You have to actually execute as well.
Absolutely. It's all about the implementation. Absolutely.
Yeah. So let's get into infinite banking system a little more and talk to me. Just give me an example. Walk me through what that looks like for someone, say who you talk to, and they're like, yeah, I don't know anything about it. Tell me.
Yep. No, exactly. Yep. And again, I'll give you the high level. So I do have a full recorded presentation on this. It's 90 plus minutes on our website, themoneymultiplier.com, where I go over it in great detail. But let's just talk about what it is. What is the infinite banking concept? The concept has been around for over 200 years. So it's not on trial. It's not being tested, right? All we're going to do, Tim, is we're going to use the tools that the wealthy have been using for over 200 years. So the thing that we're not doing is reinventing the wheel. We're just going to use the tools that the wealthy have been using and we're going to follow what they've been doing. So this concept has been practiced by the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays. If you go out and research as far as Walt Disney, this is how Walt Disney started Disneyland. It's how Ray Kroc funded McDonald's. It's how Pampered Chef got started before Warren Buffett bought Pampered Chef. There's a guy out there by the name of Robert Kiyosaki. You guys in the real estate world know who Robert Kiyosaki is. He's famous for a book called Rich Dad, Poor Dad, but he also wrote another book called Second Chance. The method that I teach, Robert Kiyosaki talks about in that book. But for all of those of you that have read the book, the things that you have no clue what he's talking about because they make it too difficult to understand. And I break it down and make it simple. But it's in that book. There's another guy named Tony Robbins. He wrote a book called Money Master the Game. The concept that I teach is in chapter 5.4 of that Tony Robbins book. But again, they make it too complicated. You read the book, you didn't understand what in the hell they meant, right? So the concept's not on trial. It's not being tested. This concept, the infinite banking concept, is okay. So the machine that we're going to use to build wealth, I'm about to tell you what that is, and it's going to surprise you. And it's going to surprise a lot of your listeners after I tell you what it is, because you're going to be thinking, man, that just ain't right. That just seems too good to be true. No, Brent, that doesn't make sense. Okay, so the machine that we're going to use to build, keep, and create wealth, here it comes. You ready? It is a whole life insurance policy in a mutual company that pays dividends. Now, I just said that word life insurance, and I don't know how many people just turned off the podcast or hit X, delete, leave meeting, whatever it is, wherever you're watching it at. because what they think is that they already know everything there is to know about whole life insurance. And they don't, because if you understood this concept, you would be using it in your own life. Now, just to be clear, Tim, this is not a whole life insurance policy that you can go and buy from your brother-in-law that sells life insurance. We all have a brother-in-law that sells life insurance. A person that sells life insurance is like a chiropractor. They're on almost every corner of every intersection, right? No, this is not that type of policy. This is a specifically designed, a specially engineered whole life insurance policy in a mutual company that pays dividends, that has high immediate cash value. One more time, high immediate cash value. And that means when you put money into this policy, you have the cash value to use immediately. My definition of immediately is within 30 days. As I said, the concept's been around for over 200 years. The number one purchasers of whole life policies, of these types of policies, are conventional banks. Conventional banks own more in whole life insurance than all of their land and their buildings combined. And as a matter of fact, since 2013, conventional banks have quadrupled the amount of whole life insurance that they purchase. Now, why on earth do you think conventional banks are buying so much in whole life insurance? Is it because they're stupid, or they know something the rest of us don't know? That's right. They know something the rest of us don't know. So all we're doing is we're going to mimic and imitate what the wealthy have been doing for over 200 plus years. And we're going to use these cash value life insurance policies to pay off debt, to pay off expenses, to buy products and services that you're buying anyway, invest in real estate. I don't care if you want to buy a house, a car, a bicycle, a boat, an airline ticket, a tank of gas, a pack of chewing gum, or anything you want. All we're doing is we're adding this one step in our financial life. And when you add that step and run your money through the policy first, and then use the money to do all of those things, now that money, Tim, it's staying inside of your family. See, there's no money being leaked out whatsoever. You are now, the thing you're doing is you're recycling and recapturing all of your money. And let me explain what that means, recycle and recapture. Tim, I really don't know you that well, and I don't know your listeners, right? But this is money right here, okay, that I'm holding in my hand. This is a $20 bill. Now, the thing we have to understand is, what is money? What is the definition of money? And if I ask you and the listeners what the definition of money is, you're going to give me different answers. But all it is a means of exchange. That's all it is. All we do with money every day is we exchange it for products and services. We exchange money for food for money, car for money for car, house for money for house. All it is a means of exchange. So the thing I do in my full 90 plus minute presentation is I show you how you can get all the money back for all the cars you're going to buy, drive, and own for the rest of your life. I go through a detailed example of that. And I know what you're thinking, and I don't know what your listeners are thinking right now. You're thinking, Brent, what? So, like, how to get the money back for my car? Tell me what that means. Let me explain. See, I don't know you or the listeners, but I know how you buy cars. The way you buy cars is one of three ways. You pay cash for the car, you bank finance the car, or you lease the car. That's how you bought a car, because I think you guys are all honest and you didn't steal the car, right? So in order to buy the car, what you had to do, Tim, is you had to take your money, you had to give it to the car dealer, and the car dealer gives you the car. So he's got the money, you get the car, transaction is over, everybody goes home happy. But when you add this one step in your financial life, Tim, not only do you get the car, but you get the money back. So here's what we do. Now, the thing I do is I give the car dealer the money. He gives me the car. He's got the money. I got the car. But by adding that one step, by running that money through the policy first, I'm now able to recycle and recapture all of that money for the car. So not only do I get the car, but I get the money back. And that's what I teach you. I teach you how to build, keep, and create wealth through all of your debts and expenses, your investments that you're already doing. Because no matter what's going to happen, you're going to buy a car and you're going to continue to buy cars, just like the car you're driving now is not the first car you've ever owned. You probably aren't driving the second car or the third car, and you're going to continue to go through life and buy and drive cars and sell cars and buy cars. And out of all of the cars you've ever bought up to this point of your life, I'll ask you in the audience, how much of the money do you have? And here's the hint. The answer is zero. So if I do nothing more than show you how to recycle and recapture the money and get all the money back for the car, that's a great thing. And if I can show you how to do that for a car, we can use it for any product or service, a boat, a bicycle, an airplane, a house, real estate, your taxes, your charitable giving, whatever it is that you're spending money on. So essentially, Tim, the thing that we're doing is we're turning every liability into an asset, and we're turning every depreciating asset into an appreciating asset, because not only now do we get the products and services that we buy, we also get the money back. And that is what Robert Kiyosaki talks about in the book Second Chance. And that's what Tony Robbins talks about on chapter 5.4 of Money Master the Game. But they just make it too complicated to understand. And I'm not a very smart person. I like things very simple. So I explain the concept very simple. But the machine that we're using to build the wealth is a whole life policy in a mutual company that pays dividends. And the reason we're using that vehicle, and again, I'm not saying that's the only vehicle to do that with. No, you can use other vehicles, but there is no other vehicle on this planet that has these features and benefits that works as well as this. And if there is one, I've been looking now since 2006, so for 17 years, for something better. And I always ask my audience, I say, tell me something better that I should be doing and not this. And if you can show that to me, then maybe I'll stop doing this and start doing what you teach me. But nobody's been able to show me that up to this point. But it is an outside of the box concept, because Tim, this is not what your parents taught you about money, your grandparents, your friends, your colleagues, and your coworkers. So you have to think outside of the box, because if you think inside of the box, the thing that you're going to get is exactly what they get. They're going to tell you, put your money in the 401k, the IRA, the pension, the retirement, the mutual fund. How is that working out for most of you? It's not. Most of you are either yourself or you know somebody that's taking a bloodbath in those vehicles. I talk to them almost on a daily basis. So this is outside of the box thinking. This is what the wealthy do. And all we're going to do is mimic and imitate what the wealthy do. And I'll say one last thing and I'll throw it back to you. I want you to think of all of the tools. Okay. So the thing is, Tim, there's us and the super wealthy, us and the super wealthy. We all have access to the same financial tool. The only difference between us and the super wealthy is they use the tools differently. That's it. Now that I know the game, now that I know how to play the game that the wealthy have been playing for over 200 years, I'm just playing the same game that they are, and I'm building, keeping, and creating wealth the same way that they do. Not by changing your cash flow, not by working harder, not by taking additional risk or losing control of your money, by adding one simple step in your financial life.
All right. And I understand I understand this concept at a rudimentary level. I think I would say I've been introduced to it, but I'm by no means an expert. So if I go off track, then let me know. But basically the biggest advantage, as I understand it, is the fact that you have this cash value, and then you're able to borrow against that cash value And while you're borrowing against that cash value, you're still getting the dividends associated with the original amount of money that you have in the account, not the remaining balance. Is that accurate?
That is accurate. And that's a good point. And I'm just going to elaborate on it a little bit. As far as in a policy, it's always up to you how much money you want to put in the policy. I never tell anybody how much money to put in. I have clients that put in $150 a month, and my largest client puts in $540,000 a month. So just pick a number in between there. And so the way you pay your premium into the policy is you can pay it monthly, quarterly, twice a year, or annually. So you choose the amount, you choose the mode. You can always lower your premium when you start. It's up to you what you put in. So the thing you do is you put money into the policy. Now, the way we design the policy is very different than your brother-in-law is going to design it. Your brother-in-law will not design the policy this way. Number one, he has no idea how. And number two, he's not going to design it that way because he doesn't want to take the cut in the commission. I take a 60 to 90% cut in my commission to design your policy this way. This is why you don't see them design this way from the life insurance agent down the street. Number one, they don't understand. And if they did understand, they wouldn't do it. So the thing you do, Tim, is you put the dollar amount that you choose into the policy. Now, it is a life insurance policy, so it is a payment of premium. We make a payment into the policy, okay? Now, but I tell my clients, I say, I want you to think of the premium payment as a deposit. It is a payment, okay? Don't get me wrong, it is a payment. But if it goes into an account that you control and you have immediate access to the cash value, remember my definition of immediately is in 30 days. Is it really treated more like a payment or a deposit? It's treated like a deposit. And tell me what word you like better, payment or deposit? Deposit. Have you ever made too many deposits in your bank account? Never. So now the thing you do is put this money into the policy. It buys you X amount of death benefit. I don't care about the death benefit. We're not here today to talk about life insurance and death benefit. It just so happens to be this is the vehicle that we're using, but it is life insurance and you do have a death benefit. What's important is the cash value in the policy. So, Tim, if I solve your need for cash and finance, you'll have more death benefit than you can ever imagine. So, now to go on what you said, the thing we're going to do now, we have this cash value and we borrow from the general fund of the insurance company. Now, I go in real depth into detail of how that works in my presentation, but I show you how you borrow at a higher rate than what you're earning and make money all day long. And it's compounded growth, like you said. So see, the policy itself, Tim, it has a guaranteed growth rate inside of the policy. Nobody in your state or any state in this country has ever lost money in a whole life policy in a mutual company that pays dividends. It's never happened. Go look it up because the insurance company is not regulated by the feds. It's state regulated and it goes by something called Austrian economics, where $1 has to protect $1. It's not like the fractional reserve lending. A bank can loan $8, $10, or $12 for every dollar that you have on hand. If everybody made a run for the bank right now to get out all their money out of the bank, you would get 8 or 9 cents out of every dollar because there's not that much money. They don't physically have that amount of money. That all that 250,000 FDIC insured bull crap would go right out the window. They just don't have it. You can't do that in an insurance company. $1 has to protect $1. The money has to be there. So the thing that you have is you have a guaranteed growth rate in the policy, and then you have a guaranteed growth rate plus dividends, which is called the non-guaranteed column of an illustration. There's a guarantee and a non-guaranteed. Now, the policy, Tim, can never, ever perform any worse than the guaranteed side. But in the insurance industry, here's what we say. The thing we say is the guaranteed column in that policy contract. It really means it's guaranteed to never perform that way because it's always going to perform better because of the dividend. even though dividends are not guaranteed, every insurance company that I work with has been paying dividends for over 122 consecutive years without fail. Now, 122 years ago, that was back in the year 1900. I have insurance companies that have been paying dividends 187 years. I'm just telling you, the worst one is 122 years. So year after year, consecutively, 100 plus years, they paid a dividend. How does an insurance company pay a dividend? They have a profit. And how is a dividend distributed? It's a mutual company, so there's no stockholders, there's no shareholders. You own the policy contract, not the insurance company. You own the contract. So you are in number one position of that money. You make the profits of the insurance company and not the stockholders and the shareholders of, say, the conventional bank. So now you have this cash value. The death benefit is always higher than the cash value. Now, as the policy continues to age, the cash value and the death benefit both rise. The cash value rises faster and eventually, and so this normally happens at age 121, your cash value and death benefit are equal. Now, I haven't talked to any clients yet at age 121, but maybe one day I will, right? But at that time, if you're still alive, the insurance company just pays out the death benefit. They don't want to play with you anymore. They're done playing in the sandbox. They pay you out the death benefit, and the deal is over at age 121. But before then, Tim, the death benefit is always higher. Now, okay, so here's the important part, and this is crucial that your listeners get this. Very important. Whenever you take a loan from the insurance policy, you are not borrowing your money. No, what you're doing is you're putting your policy up for collateral and you're taking a loan from the general fund of the insurance company. So all of your money that's in the policy is continuing to compound and grow. It's uninterrupted growth. So what you're doing is you're earning the growth on your money and you're using it at the same time. Now, the insurance company can never lose because remember, the death benefit is higher than your loan availability, and you are guaranteed to die, pass, or graduate. I like to use the word graduate, but whatever word you want to use. It's not an if, it's a when. We all come with an expiration date. We don't know when it is. At the time of your death, the death benefit will pay out to the beneficiaries tax-free. If you have a policy loan, let's just hypothetically say, we'll use a random number and we'll say the death benefit is $1 million. And we'll say that you have a $600,000 cash value and you all the money loaned out. At the time of your death, what happens is the $1 million will pay off the $600,000 loan because they've already given you that money while you're living. So really what you've been doing is you've been using your death benefit or a good portion of it while you're living. And so the thing they'll do is they'll pay off the $600,000 policy loan and the additional $400,000 will go to your beneficiaries tax-free. You never have to ask or qualify for a policy loan. Whenever you have cash value in your policy, we simply call up the insurance company. Hey, I want a policy loan. Great. How much do you want? Do you want max available? Okay. Would you like a check sent to you or do you want it automatically deposited into your checking account? The insurance company never asks you why you want a policy loan, and they never ask you if you plan on paying it back because they don't care. They don't care. So essentially what you're doing is a loan is a prepayment of the death benefit. So guess what I do, Tim, with my policy loans? I hardly ever pay a policy loan back because if I can borrow from the insurance company, let's just call it 5% simple interest for easy math. And if I can borrow at simple interest at 5%, can I take that money? Can I take that money and go put it into a real estate deal and make 8%, 10%, 12%, 16%, 18%? I have people standing in line. I have people that are wanting to borrow money standing in line that will pay me 12 to 18% all day long on money that I am willing to lend them. And they'll put me in first position on real estate deals. So if you're looking for lenders, let me know. If you're looking for borrowers and you're a lender, let me know because I have lots of contacts that I can hook you up with. It's like a dating service for borrowers and lenders, bringing them all together. And I'm always open to share with you exactly the stuff that I do in my financial life. So the last thing I'll say on this topic is that the idea is to get all the money in the policy first. Every dollar that runs through your hands, you would love to get the money into the policy first because it's going into an account that you control. It has guaranteed compounded growth rate. The growth is growing tax free, and the government is completely out of your hair. So once you get the money in the policy, now from the policy, take the money and make the real estate investment or buy the real estate or do the syndication, whatever it is you're going to do. And when you do that, Tim, when you add one step in your financial life, it drastically changes the financial game. Because see, when you recapture and recycle that money and there's no money being leaked out to other people, it makes a world of difference in your financial life.
Yeah. And so let me ask you, in terms of how I view this and what in my perception might be one of the weaknesses, I guess, of it. It seems like it's very beneficial for either A, someone who is a high net worth individual, a high income earner, or someone who is starting very young, very early. So you have those two groups, right? You have the one person who's 21 years old and puts in $100 a month because they have that advantage of compounding over such a long period of time and can build up that account. And then you have that other person who's just, I can dump 100,000 a month. And then because the borrowing power, for lack of a better word, is based on how much you put in, that person who's in the middle, that middle income earner who can only afford to put in, say, a couple hundred a month in their 40s, it's going to take a lot longer to build up that piggy bank to borrow against. Is that accurate?
So let me answer it this way. It doesn't matter if you make $10 an hour or $10,000 an hour. Everybody needs to break the bonds of financial slavery they don't even realize they're in and start taking control of their wealth. So the policy of my client that puts in $150 a month is exactly the same as the policy of the client that puts in $540,000 a month. The growth is exactly the same. It's not designed differently. It's just the growth on a smaller number versus a bigger number. That's it. That's it. The same growth is happening. So, yes, I realize people have to start somewhere. I started my very first policy in 2008 at $2,000 a month. I did not have all 24,000 to put in one lump sum. If we fast forward today, I have 25 policies and I put in a little over $700,000 a year in my premium. And I buy at least one policy every 1 to 2 years because I want as much money in that policy in the third year and beyond as I possibly can get. So my 23-year-old daughter has 5 policies. She's putting in about $95,000 a year into her policy right now, buying a policy every year. So it doesn't matter where you start, how little or how big. The important thing with the policy is time. See, even though the policy that I have, my very oldest policy, my first policy, I started in February of 2008. That's not my largest premium policy. It is my most efficient policy because it is the oldest policy. So the growth rate will never be as big on any of my other policies in my very first one because of the time. So that's all it is. That's the only difference is time. The more time, the more growth. But what's going to happen? It doesn't matter. You're going to spend the money anyway on the products and services that you're buying, the investments. You're going to go do all that anyway. So why not add that one step? It doesn't matter if it's $10 an hour or $10,000 an hour. You put that money into the policy And now it's growing uninterrupted compound interest. So the number doesn't matter. Obviously, the bigger number, yeah, the bigger number that's growing. But the guy that puts in $150 a month, the policy is not designed any differently than the $540,000 a month. It's just a different number. Because you see, Tim, I eat, live, and breathe this stuff. So when I design your policy, I design it the same way I design mine. There's no secret sauce I put on my policy that I don't put on yours. All right. That's how I design it. And probably you're wondering, Brent, how do you make money? How do you get paid? Here's the cool part. You never write me a check for a dime. You're never going to write my company, the Money Multiplier, a check for a dime. See, I get paid, Tim, the same way your car insurance guy or gal gets paid. So let's say, for example, John Smith is your Allstate car insurance agent. Whenever you pay your car insurance, you don't write a check to John Smith. You write a check to Allstate. Allstate pays John Smith a commission. That's how I get paid. I get paid a commission on the policy that you start. And if you decide to do this, hopefully you want to do it with me and not the guy down the street, because the guy down the street doesn't understand how to do this concept. And if he, why hasn't he told you about it already? So I get paid a commission on your policy. I don't determine the commission I get paid, and you, the client, does not determine the commission I get paid. The insurance company determines what that commission is. There's no hidden fees. There's no extra charges, right? But there's a lot of additional things that we offer. There's a lot of services that we create for you. We call them policy tools. And when you watch my full 90-minute presentation, you will see those tools like the cash flow analysis, the money multiplier map, and we constantly update those tools for you 2 to 3 times a year, every 4 to 6 months. And you never write us a check for a dime. That's part of us that's, or as the servicing agent, that's the value that we bring to you with not only designing your policy for the maximum cash value to use for the banking concept, to use the money immediately, but also ongoing tools that we provide you.
Okay. And something you said raised another question for me, which is what is the advantage of having multiple policies
Yeah.
versus just the one? Because in my mind, I'm like, why not just dump more money into that one policy? Why would you have multiple policies? And I'm wondering if there's additional costs associated and what's so great about it that it would offset any additional
Yeah.
costs.
Yeah, great question. The reason we have multiple policies, the quick, simple answer is to avoid the MEC limit, MEC. Now, let me explain. Let's just say, Tim, that you have a policy and you started a policy, and let's say you're putting in $1,000 a month, okay? 12,000 a year, 1,000 a month. And all of a sudden, the thing that's happening is that you're trucking down the road and you're like, man, this is working really good. I want to put in 2,000 a month instead of 1,000 a month. Let me just put it in the same policy. You cannot put it in the same policy because if you try to overfill that policy, it becomes this thing called a MEC. MEC, it stands for Modified Endowment Contract. Now, in this book, Becoming Your Own Banker, Nelson Nash talks about this in great detail on page 38 of this book. So the MEC came into play by our good old government back in 1988 because all these people were stuffing all this money into the policies, and the government said, wait a minute, no, we can't do that. So they threw in this thing called the MEC limit. And the MEC limit says if you overfill your policy, then it becomes a MEC and it's no longer treated as an insurance contract, and it's treated as an investment, and it's subject to taxation. So when we design your policy, we snuggle it right up to the MEC line without going over it. So that's why you do more policy. I have a glass here, and let's hypothetically say this glass holds 12 ounces of water. No matter how hard I try, Tim, I can never get 13 ounces of water in this glass, right? I can't overfill it. Same thing with the policy. So I can't overfill it. So if you want to put additional money into it, then we have to start another policy. Now, with that being said, you generally can get 10 to 15% more in the policy than what you originally started with. But to go from, say, 1,000 a month to 2,000 a month or a big number like that, you can't do it. Now, last point on that. I personally have over 7,000 clients in every state of the country. 91% of my clients that have been with me a year or longer come back to start additional policies because they want to put more premium into the policy. So they start additional ones. Of those 91%, almost 70% of those come back before the first year is even up because they see how effective this works, how efficient we work with them. Once you start your first policy, I will never, ever have to call you and ask you, hey, do you want to put more in? 91% of the time, you will come back and say, hey, I'm ready to do another policy. I want to put more premium in it because you see how efficient this works. One last point on that. I tell people all the time the thing I love most about my job, more than anything else. And again, I love what I do. And I'll try to bring a bit more passion the next time we have an interview. But the thing I love about my job is nobody is ever mad at me. See, people don't get mad at you when you're helping them build, keep, and create. If I do have any clients that are mad at me, they're not telling me about it. They're keeping it a secret, right? If this wasn't working, there's no way that 90% of the people are coming back to get more. So it is a total game changer. And I'm going to challenge your clients. Don't take my word for it. Go Google my name. The guy that I wrote the book with, I wrote a book it's called like Mapping Out the Millionaire Mystery. Where did the book go? Here, hang on here. I wrote a book called Mapping Out the Millionaire Mystery, and I wrote it with a guy named Chris Naugle. Now, a lot of you guys in the real estate world have heard of Chris Naugle. And if you haven't, go to chrisnaugle.com. Chris Naugle lives in Buffalo, New York, very active in real estate. He's had 2 TV shows, one on House Hunters, another one on HGTV called Risky Builders. Chris has been a client of mine for years. His TV show got canceled because if you know anything about HGTV, it was bought out by Discovery Channel. When Discovery Channel bought HGTV, they canceled all of their real estate shows. Chris Naugle was in the cancellation thing, so his show got axed. And he says, Brent, he says, I want to do what you do. Now, Chris Naugle worked for New York Life for 16 years. They never showed him this concept in New York Life. They never taught it to him. And he was a stockbroker as well. And Chris said, hey, I want to start doing this. He became a client. And then he followed me around for years as I was teaching for 2 solid years. He followed me around to every city. And now Chris Naugle teaches this on stage. And he's a part of our team here at the Money Multiplier. And now the student has become the teacher. So follow Chris Naugle, especially just like if you're into real estate, go to chrisnaugle.com. So let me give another plug out there for someone in real estate. There's a guy named Devin Burr. He lives in Phoenix, Arizona. He has over 1 million followers on, I don't know, Instagram, TikTok, Twitter, right? So I get all that stuff mixed up. I don't understand the whole social media deal. Maybe because I'm 56 years old. I don't know. But anyway, he has over 1 million followers. And if you go out there and follow Devin Burr, it's MR underscore Burr, BRR. Now his last name is spelled Burr, BURR, but on all the social media, it's MR underscore BRR. He has over 1 million followers and he's a real estate investor. And Devin has tons of videos, content about how he buys all of his real estate by using this concept, the infinite banking concept, and he's recycling and reusing the money. So all the real estate deals he buys, he's reusing that money over and over again. So you definitely want to follow chrisnaugle.com and you want to follow Devin Burr, especially if you're into real estate.
All right. Hey, and I know we can talk for hours about this if we have the time, but we do need to move on to the turbo round now. All
Okay.
right.
Very good.
I am going to ask you three questions that I ask every guest that I have on my show. And I just ask you for an honest answer. The first one, what is one red flag every investor should look out for?
Yeah, the one red flag I would look out for is who are you taking advice from financially? Is their portfolio, take a look at what they're doing, because it's real easy to get advice from our broke ass brother-in-law, right? That has less than what you have. And it just happens. And again, be careful of who you surround yourself with, because basically your net worth is equal to your net worth, right? Don't get into that mindset that you have to be like everybody else in the group. Sometimes you have to fire your friends that you have because they will drag you down. And I hate to say it, but sometimes you have to fire members of your family because they will drag you down. So family members, I'm not saying you can't go eat Christmas dinner, Easter dinner and watch football on Sunday. I'm not saying that at all. But when it comes time to building, keeping, and create wealth, be very careful about who you associate yourself with.
It comes down to that. You're the average of the 5 people that you surround yourself with. Point.
Yes.
All right. Next question. What is a myth about this business that you would like to set straight?
Yeah, look, there's a lot of chatter out there. There's a lot of opinions. I suggest everybody looks and does their own research. But a lot of times people think they start at a certain level. They have to start with money or from money. A lot of successful people, whether it's in the real estate world or anything else, they actually start deals with using other people's money. They come into it and they have nothing, but they have the kind of like the desire, the grit, the determination, the fight. I keep saying, just dig the ditch. If you keep plugging through the shit, the thing is that you will find the pony down there somewhere. It's down there. Keep shoveling the shit and you'll find the pony down there somewhere. So don't think that you have to start with something. You just got to start with mindset. I like to say 3 things is what everybody needs. They need mindset, they need systems, and they need mentors. So the first step is getting your mind, and then find a system. Find somebody that has what you want. Find a system so like as far as find somebody that's doing something, that's doing it well, that you want to imitate and follow that system, and have a mentor that's going to help you to do that. So let me just tell you a quick thing. All right, so my next door neighbor is a guy named Gary, and he started a company, and it's called Rural King, Rural, Rural King. They're like home and garden stores, small versions of Home Depot, right? He has over 113 stores. His wealth is, he brings over like $1 billion a year, massive wealth. The most coolest down to earth guy you would ever meet, right? I want to pick that guy's brain as much as I can. So find somebody and just learn from him. Buy him a cup of coffee or a sandwich, or say, hey man, can I walk with you through the neighborhood when you're on your walk to pick a brain? Don't be scared. People want to tell you. They want to tell you the thing is just what they've done, but the majority of the time they won't, because it comes across as egotistical. I love for people to ask me all the mistakes I made or the stuff that I'm doing that's really working. I hide nothing. I hide nothing at all. I'll tell you everything that I'm doing, everything that I did to get me to where I'm at now. And I'll tell you the things that I wouldn't do and the mistakes that I've made. And I'll tell you one mistake that I believe, and again, Tim, you may not agree with this, a lot of your listeners may not agree with this, is I don't like being in second position on anything. I want to be in first position. If I'm not first, I'm last. Now, a lot of times you'll hear, I got better returns for you if you're in second position. No. Pigs get fat, hogs get slaughtered. I don't need to be a hog. I just want to be a pig. If the deal sounds too good to be true, most of the time it is. So peel back the onion. Just like on this concept that I'm sharing with you. It sounds really good. But even if you wanted to do this in your own life, it's going to take 6 to 8 weeks before you could even start. If you told me, Tim, you're ready to start today, it's going to take 6 to 8 weeks to get you approved, to get your policy started. So you got the next 6 to 8 weeks to dig through every research that you want and peel back the onion. And if you're not confident or sure in 6 to 8 weeks, then you should walk away from it and not do it, because it's not going to happen.
Yep, absolutely. Okay, and the final question, what does success look like to you?
Yeah. So look, I believe that I was put on this earth to serve as many of God's children as possible. God gave me 2 ears and 1 mouth, so I should be listening twice as much as I talk. I still haven't learned that yet. I'm still working on that. But again, I don't ever want to have what we call the arrival syndrome. In that book, Becoming Your Own Banker, Nelson Nash talks about the arrival syndrome. And what that means, he's saying that, hey, I know everything there is to know about a specific topic, and nobody can teach me anything else. It's like right now, a lot of your listeners are saying, nope, I know everything there is to know about life insurance, and Brent can't teach me anything. No, you don't know, because if you did know, you would be doing this. So keep an open mind. You don't have to agree with me, but but the thing is, keep an open mind, bring information in. So I want to serve as many people as possible. I don't believe in the word retirement. The word retirement is not in the Bible. Go look for the word retirement and try to find it. It's not in there. The word retirement means you stop serving others, in my mind. Okay? So from a life of, as far as being able to give, I want to continue to serve. So I believe that on this concept that I teach, that my lips will still be moving when they're throwing dirt on me and they're burying me into the ground. I'll still be talking about it, so I'll never stop at all. From a perspective of being a success financially, is whenever your passive income surpasses your expenses and the money that it requires to take in life. So if I have more passive income coming in than I have expenses going out, what else is there as far as financially? And I'm an aviator. I like toys. I have boats, wave runners, motorcycles, jet skis, 4-wheelers, airplanes. I have 3 airplanes. I love to go on vacation. I told my wife, I said, what else do we need? What else materialistic are we going to buy? And I'm going to tell you, Tim, and I had a mentor tell me this. He says, the thing you're going to do is you're going to go through a certain point of your life, and it's going to be all about acquiring as much as you possibly can. Acquire things. That's just how we're programmed. But then you're going to get to a certain point to where it's just not as fun anymore to go out and buy that next thing or stuff or whatnot. And now you have a different direction of what you want to do and what kind of, as far as what kind of plan or what kind of thing you want to leave for other people. They call it a legacy. What legacy do you want to leave? So it changes in your life. And it changed for me about 2 years ago. I'm like, I understand how wealth is built. We're building wealth. We're keeping money in the family. I don't need to acquire anything else. I just want to serve as many people as possible, because I know what I teach, most people aren't going to do, because they're scared to get out of line. They're scared to go and do something else. The thing I tell my kids, I preach this to my kids all the time. I say, Zach, Hannah, I want you to watch what the masses of people are doing, and what the masses of people are doing, you go do the opposite. You go do the opposite of what the masses are doing, and that's what we have to do. But most of us are not comfortable doing that. You have to get uncomfortable. If it feels creepy, if it feels uncomfortable, if you feel embarrassed, if you're sweating, if your palms are sweating, good for you. You're doing it right. Keep doing that, because at the end of the day, it doesn't matter what anybody else thinks about you, as long as you're moral, ethical, and you're doing things legally, right? So the more you put out into the universe, the more you get back. Last statement I'll make on this, the late Zig Ziglar, my favorite quote by Zig Ziglar. Zig Ziglar says, if you help enough other people get what they want, you'll end up getting what you want. So serve others and it'll come back to you. My other quote is by Warren Buffett. I don't know when Warren Buffett said this, but I heard it in October of 2008. Warren Buffett said it's just this simple. If poor people would just start doing what rich people do, they wouldn't be poor anymore. How much sense does that make? So that's what we're doing here, ladies and gentlemen, boys and girls. We're just going to mimic and imitate what the wealthy do.
All right, Brett, I love the passion that you bring to this topic. And obviously, there's a lot more that we can go into that we don't have time for on this show. So please tell our guests how they can get a hold of you and if you have anything else that you'd like to share with them.
Got it. So again, okay, if you want to email me, my email is Brent, B-R-E-N-T, Brent at themoneymultiplier.com. My website is www.themoneymultiplier.com. I wrote this book, Mapping Out the Millionaire Mystery, about 3 years ago. If you want a copy of the ebook, you can either go on our website and just follow the directions of how to get the ebook. Or if you send me an email, Brent at themoneymultiplier.com, I will send you the ebook for free. And also what you can do is you can go on our website, themoneymultiplier.com, and I think it's like /presentation. And all you got to do is click Watch Brent Now. And my full 90+ minute presentation on this concept is on there. It's also broken down into 10 sections if you want to watch it a section at a time. All of my downloadable attachments and my examples are there. So if you want to watch the full presentation, either email me, I'll send you the ebook and the presentation, or just go to the website and you can get that information yourself.
All right, great. And we certainly appreciate you providing all those resources to our guests. And we'll have that information in the show notes. Again, Brent, I appreciate you coming on and look forward to continuing to see you do big things on your journey.
Awesome, Tim. Thank you so much for having me, and I'm very grateful to be on. So I appreciate you allowing me to share with the listener. We'll see you later.